before this computer. Perfect. So let's see who texted first. Yeah, it's being recorded. All right, today's session is going to be 1 hour. So I'm going to start timing it from now. I want to make it 1 hour so that you guys could go do the other things you guys want to do. Okay. So anyways, I told you guys yesterday to go do exercises on identifying intermediate term lows and highs, long-term lows and highs. Okay. And I told one of my students I was going to review what is sent out to the group. So let's see, hopefully everyone can see this. Perfect. So Bailey sent me this, let's see, Bailey's chart on GBP USD, I think. Set this. Bailey sent me GBP USD chart. Where is it? No. Okay, yeah, I think, no, not really. Still not really. I think Bailey maybe removed the chart, so. I actually wanted to go over Bailey's chart. Bailey sent out something on GBP USD, so I wanted to go through that, the first thing, before we went into the schedule for today. So rather than doing that, we just use an entirely new chart. Let's see, GBP USD Wanda. Let's just Wanda. So I'm gonna remove this. We will drawing tools. Now, from definition yesterday, I told you guys an intermediate term high or low has two short-term highs on either side of it. Okay, and you can use your daily time frame or your 4-hour charts. So now, here was an I. Okay, there's an I here. Let's use next. Let's mark this X. Oh, that's big. Okay, perfect. Use blue. Perfect. So we mark this area X. So this is an intermediate term high. The reason why is because there's two short-term highs on either side of it. Okay, two short-term highs on either side of it. Okay, this constitutes an intermediate term high. Mark this one, intermediate term high. Now, for you to get a long-term high, you need to have two intermediate term highs on either side of it. Okay, that means you need to get an eye to the left of this one. Okay, that has two short-term highs on either side of it. Okay, then another one. So we mark this X, intermediate term high, one to the left, one to the right. Okay, so now the reason why is because there's one short-term high, another short-term high, another. It's not really that visible on the daily time frame, but if you break it down to like the 4-hour time frame, you're gonna see clearly. Okay, the left side is gonna be a swing high, probably a 4-hour swing high. The right side, 4-hour swing high. So these constitutes an intermediate term swing high, intermediate term swing high, intermediate term swing high. Okay, 1, 2, 3. So together you get a long-term swing high. Okay, so this was a long-term swing high. And you can see the market rallied down for about 118 days is about 5 months. Yeah, for about 3, 4, 5 months. Okay, so that was a valid intermediate term swing high. This is a valid, long-term swing high. This is a valid long-term swing low. Okay, you have a low, mark this by X. Higher lows on either side of it. If you go to your 4-hour time frame, you're gonna see 4-hour, probably the 1-hour time frame. You're gonna see short-term lows on either side of it. Okay, we have another one here, another one there. Long-term swing low. Then the market rallied for 3 months. September to October, November, December, 3 months. Okay, so this would be a long-term swing low, long-term swing high. Okay, then in between this long-term swing low, long-term swing high, you have your intermediate term highs, okay? No, highs, okay, highs, intermediate term highs, and intermediate term high, long-term low. This is the long-term low. So that's basically what the assignment yesterday was all about. Okay, perfect. So now, hopefully everyone is clear with what I said just now. Some of us aren't on your team chat. How do we send our exercise? Check if you're correct. Right, so send me your exercises on Instagram. Okay, send me on Instagram. Send me the links on Instagram. I'm going to check the links and I will correct if you're right or wrong. Okay, perfect. So now let's go to today's schedule. Today we're going to talk about the commercials. I was actually supposed to go over that yesterday, but there was not really enough time for us to cover that. Today we're going to do that. Okay, the commercials. So now, who are the commercials? Commercials are entities or entity that makes the top of the supply and demand chain in the market. So they influence price movements on the charts in real time via business transactions and share influence in the marketplace. Okay, so the commercials, short term for comms, are an entity comprising of varied players, such as the central banks, a large-scale commodity supplier, and small-time price data feeds. So they are very early in the moves and create the market environments for every other players in the marketplace. Every other player in the sense of the retail traders, okay, the institutions, the hedge funds, all those people. So it is the commercials that create the environment for every single person in the marketplace to speculate in. So without them, there is not going to be a Forex market. Okay, so they are the ones that create the environment for everyone to be able to speculate in, whether be it the real-time businessmen, okay, importing and exporting goods or products from one country to another that influences the price movement in the market, or the hedge funds or retail traders trying to trade in the market. Okay, these commercials are the ones who create the market for every other market players to speculate in. Okay, so the commercials make up the largest portion of the Forex market by sheer volume and thus influence price over an extended period of time. They are also in the business of profit making. So this last statement should have a profound impact on your psyche as a trader. Okay, let's see the chat. Yeah, so if your computer screen is blurry, it's your Wi-Fi. Okay, not mine, your Wi-Fi. So the commercials make up the largest portion of the FX market by share volume and thus influence price for an extended period of time. They are also in the business of profit making. So this, like I said before, this last statement should have a profound impact on you as a trader. That means if these people, right, have the power to be able to move the market a certain direction for a period of time, that tells you that at will, they can get your money. Okay, so these people move the market sometimes based off where the volumes are, be it the volumes of the hedge funds or the volumes of the bulk of the retail traders. Okay, so now let me show you guys a standard commercial accumulation to a distribution phase. Okay, so if you guys have your phones right out with you, try to take a picture of the diagram I'm going to show you guys next. All right, so let's go to Google Chrome. Exactly. So now this is the standard commercial hedging fees. This is how the commercials create the market environment for every other players in the market to trade in. As the market drops, okay, the commercials buy. So now, if you go back to the notes, I said they are very early in the moves. Before any other person is buying, they've bought the market already because they are the ones who cause the market to go up. Okay, so going back to the diagram, okay, as the market drops, the commercials buy. As it drops even further, the commercials buy. As the market drops, commercials buy. So what they're doing is they are absorbing the sell positions from the other players in the market. Okay, this obviously is a downtrend, right? The market is going down. So now you need to ask yourself a question. The market is clearly on a downtrend. And on a downtrend, the majority of people in the market are selling. Okay, so if the majority of the people in the market are selling, who is buying from them? It is the commercials. The commercials are buying your sell orders. You're buying the sell orders of the institutions. You're buying the sell orders of the bulk of the retail traders and other market players. This is how the commercials make or edge the market. Okay, so as the price drops even further, the commercials absorb the sellers in the marketplace. So here they're absorbing more sellers as the market drops. They're absorbing more sellers as the market drops. They absorb more sellers as the market drops. So absorbing more sellers in the sense that you're doing the opposite of what you're doing. So while you're selling, you're buying. Okay, as you're selling, they buy. They buy from you. As you sell, you're selling to them, you're buying from you. So you're selling to them, you're selling to them, you're selling to them, then you sell to them. So now when all the sellers are absorbed from the marketplace, meaning due to the sheer volume of the institutions or the commercials buying this market, they are now net long, meaning the demand is greater than the supply. There's no more person selling to them, okay? Now that you're now net long, the market by default will start to go up. So now let me give you an example. Let's do a crude example, okay? So go down, right? Let's bring out the curve. 1, 2, perfect. Okay, cool. All right, so draw 1, 2, 3, 4, 1, 2, 3, 4. Okay. So now let's say here the institutions bought the market. Okay. They bought the market. You're buying, buying, buying. Okay. You're buying. So now around this region, let's say they bought 50 million. Okay, $50 million worth of GBP USD. 50M. Okay, boom. They bought 50M from the marketplace. But now the volume of the sellers or the sell orders in the marketplace is still around, let's say, it's still around 210. On the sell side, the volume is $210 million. Okay. On the buy side, the volume is $50 million from the commercials. Okay. So now they bought 50 million here. As the market drops down even further, then they buy 60. So let's say around this point, the bulk of sellers sold 60 million worth of pound to the commercials. Okay. So you have 60 from second buy line. Okay, so $60 million. Because remember, if you sell, someone needs to buy from you. So you're buying yourselves. So now $60 million from the 210 remains makes it left 150. Okay, so you have 150 million left, right? So let's say around this lower end, about 70 million more of pounds from you guys. That's from the institutions, from the retail traders. Okay, 70 million, or let's say $100 million from the sellers. Okay, so here is $100 million. So $100 million from the sellers. Okay, now what is actually left is $50 million. There's 50M left. What then happens is the last 50M, okay, from the sellers, they'll buy it up from the sellers. They buy the last sales, meaning they absorb the last sales. Okay, like if you look at the blue arrow at the bottom of the screen, you see when all sellers are absorbed. So now, when all sellers are absorbed, there's no longer sales in the marketplace. Now, on the buy side of the market, there is now 210 worth of bought pound USD, and there's nothing extra to sell. So by default, the market needs to go up, right? Because there is no longer supply. On the sell side, there's now demand. So by default, the market will start to go up. And once the market starts to go up, once the market goes up past where the institutions bought the first time, they hedge your positions, meaning they take profits. They take profits at small, because remember, they bought when this point was low. As the market goes up, they're still holding the buy orders. Okay, they're still holding this buy order, holding. Once the market goes up above where they enter the buy position, they close that first position. So now you're closing in profit. As the market goes up more due to the sheer volume of demand, they close in profit. Okay, they close in profit. So they close in profit. This is the standard commercial accumulation to distribution phase. So as the market drops down, they are accumulating the buy side of the market. This is why they're early into the move of the marketplace. So while they're buying from you, you're selling to them. Okay, because you can't place a sell order in the marketplace if there is no one to sell to. You need someone to sell to. The hedge fund needs someone to sell to. So who are they selling to? They're selling to the commercials. Okay, commercials are the bigger players. They are central banks and the real producers of a currency or a commodity. Okay, so everyone is selling to them, they're buying. What the standard process of them, buying the market as it drops creates the environment for every other person to participate in. Okay? Because if the market dropped and they try to sell, and you also try to sell, and the hedge funds are also trying to sell, who is going to buy from every person? Someone needs to do the opposite of what the next person is doing. This is what the commercials do. Okay, so hopefully you guys all got the standard commercial buying and selling phase. So this is how they hedge the market. Okay, it's simply called hedging. They're hedging your positions, Once they've hedged the last sell buy positions, then they restart the cycle again. All right, perfect. So now, how to capture explosive profits. Trading the weekly range is one of the most profitable ways to trade. Trading the weekly range is one of the most profitable ways to trade. The weekly, meaning if you're catching the weekly lows, the low of the week, you're buying from the low of the week and you're taking profits at the high of the week, or you're selling from the high of the week, you're taking profits at the low of the week. This is the way I do the majority of my trades. Okay, trying to get the weekly ranges, the weekly highs, the weekly lows, buying the weekly lows and taking profit at the weekly highs, selling the weekly highs, taking profit at the weekly lows. So trading the weekly range is one of the most profitable ways to trade. A weekly high or low forms most times between Sunday's open and Tuesday's London open. But 80% of the time, okay, 80% of the time, the weekly high or low will form Tuesday London open to Wednesday's London open. Now, let's look at real-time examples. Let's go to our chart. Let's see, is this statement actually correct? Okay, so now, like I love to do, anyone suggest to me a pound or euro pair? Anybody in the comment box suggest to me a pound or GA? Okay, GBP AUD, let's see, GBP AUD. Okay, remove all drawing tools. So we remove all drawing tools. Today is actually Tuesday. Today is Tuesday. When was Friday? So Monday, Tuesday, Wednesday, Thursday, Friday. Okay, the Monday's time. Okay, let's just a 4-hour time frame. 7 session breaks. I don't know why session breaks does not show here. All right, perfect. So we have our session breaks. This is Monday, Tuesday, Wednesday, Thursday, Friday. 1, 2, 3, 4. Friday. This is Monday, Tuesday. Okay, perfect. Mondays, Tuesday, Wednesday, Thursday, Friday. Now, last week on GBP AUD, okay, last week's GBP AUD weekly range, the high of the week formed on Monday. Now, if you go back to what I wrote, okay, the trading weekly range is one of the most profitable ways to trade. The weekly high or low forms most of the time between Sunday's open, Tuesday's London open. So Monday falls between Sunday's open, Tuesday's London open. Okay, if you go back 2 weeks back, 1, 2, 3, 4, 5, we have Monday. Okay, the low of the week came Thursday. So this was actually late. Okay, the low of the week came Thursday. This was due to news, whatever. Okay, go 3 weeks back, 1, 2, 3, 4, 5. Okay, the low of the week came Tuesday London open, 3 weeks back. Okay, go 4 weeks back, 1, 2, 3, 4, 5. Right, the low of the week came Monday's London open. Go 5 weeks back, 1, 2, 3, 4, 5. The high of the week came Tuesday's London open. Go 6 weeks back, 1, 2, 3, 4, 5. The low of the week came Monday's London open. Okay, are you guys all seeing the patterns? It's coming Monday, Tuesdays, Wednesdays. Mondays, Tuesdays, Wednesdays, Mondays, Tuesdays, Wednesdays. Most of the time, that London opens, okay? That is when you get your highs and your lows of the week. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. The high of the week came Tuesday, London open. Okay, it's blurry. If it's blurry, it's your Wi-Fi. All right, so someone said euro odd. It's the same thing on all these currency pairs. It's the same. Bring out any forex currency pair, you're going to see the same thing play out in the marketplace. Okay, Monday, Tuesday, boom, divide that. 1, 2, 3, 4, 5. Okay, euro odds trade that you guys saw me caught last week came Tuesday London open. Okay, last 2 weeks, 1, 2, 3, 4, 5. Tuesday London open. Last 3 weeks, 1, 2, 3, 4, 5. Last 3 weeks, 1, 2, 3, 4, 5 came Wednesday London open. Last 4 weeks, 1, 2, 3, 4, 5 came Wednesday's London open. So it's all reoccurring in the marketplace every single week. You're going to get the highest probability of you to catch the weekly high or low is on Monday or Tuesday or Wednesday, but 80% of the time is going to be Tuesdays or Wednesdays. The examples I've shown you, okay, Tuesday, okay, Wednesday, okay, 1, 2, 3, 4, 5, boom. 1, 2, 3, 4, 5. Law of the week comes Tuesday. Okay. 1, 2. Well, actually, this one was London session. Sorry, New York session, Tuesday. But still fell on Tuesday. Okay. 1, 2, 3, 4, 5. We have law of the week coming Tuesday/Wednesday. So 80% of the time, you're gonna get your low of the week or your high of the week from Tuesday's London session to Wednesday's London session. So in between that time period of 1 day, that is your highest chance due to data from the past that shows 80% of your time, your highs or lows of the week are going to form around that time frame. So what you're simply doing is if you're getting a move around that time period, you could hold that move until Friday and take profit on Friday. That way you're getting the entire weekly range. Now let me show you guys an example. You guys saw me post zero odd trade from last week. Okay, we caught this trade Tuesday London Open, and I held the trade until Friday. Normally you're supposed to take profit Friday's London Open. Okay, now if you go 2 weeks back, 1, 2. Okay, Tuesday/Wednesday you caught your trade. Okay, you hold that until Friday's London Open. Okay, you're getting 126 pips. Or you could close Friday's Asian session. You're getting 201 pips. All right. So doing the same thing, going back over and over, you're going to see 70% of the time, if you're getting your trades between Tuesday's London session to Wednesday's London session and you hold until Fridays, okay, that is your highest chance of getting the weekly range. Now, intraday, you could take profits, or on Thursdays, you could take profits. But if you hold until Fridays, that is your highest chance of getting the weekly range. So that way, that is one of the most profitable ways to trade because you're getting the maximum number of pips that is allowed on a particular pair for a week. Okay, so you're getting the maximum number of pips for a pair each week. While you're taking profits intraday, you're still swinging that trade for 2-3 days. I do this every single week. My family's Christmas and my connection will stay stable. I'm sure to catch you recording. Thank you, Jim. No problem, man. No problem, Dawson. So going back to what I was saying, you get your entries between Tuesday's London Open to Wednesday's London Open, then you hold until Fridays. That way you're getting the entire weekly range. Okay, so now during the continuation of the course, I'm going to teach you guys how to get the trades around Tuesday's London Open to Wednesday's London Open. It's extremely easy. Okay, all you need now is to get a concept and the reasons behind each and every concept. Then when I'm explaining to you guys how to do all this, it becomes simplified for you people. Okay, so now let's go to market analysis. What moves the market? The DXY is a reference for all asset classes. DXY is a reference for all asset classes. The higher time frame direction tends to stay in one direction for long periods of time. So if you get a daily bias bullish, okay, it's going to tend to stay in that direction for 2, 3, 4 weeks, 5 weeks, 1 month, 2 months. Okay, I showed you guys yesterday using your intermediate term swing lows or highs, long term swing lows or highs. Okay. Let's see. Fucking school. Risk called bearish dollar, bullish foreign currencies or commodities, a flight from dollar to higher yield assets. Let's see. Right, sorry guys. So there's two different market scenarios I compare in the marketplace. Now, when people ask me, what do you do when you come to your charts? Apart from doing fundamental analysis, which is another topic entirely, okay, when doing technical analysis, okay, what is the first thing you look at? The first thing, so I want you guys to write this down. The first thing you always want to look at is your DXY. Make sure you're writing this down. The first thing when you come to the marketplace, you always want to look at first is your DXY. For many of you guys who don't know what the DXY is, the DXY is the dollar index. Okay? DXY is the dollar index. This single index, okay, controls everything in the marketplace. Every single currency pair, every single asset class is all influenced by the DXY. Okay, so if the DXY is bearish, it's called a risk on. Now, let me give you guys a reason why. If you look at the Forex market from statistics, okay, the DXY or USD based pairs are traded 56% of the time. So they make up 56% of volume of transactions in the marketplace. Now, the reason why is because the the US dollar is the base currency of the world. Of all foreign transactions, international transactions, the US dollar is the base currency. Now, prior to 1971, it was gold. Now, Richard Nixon, which was the president of the United States, around 1971, took the dollar off the gold standard, meaning each paperback, each single paper of US dollar was no longer backed by gold. Okay, so that way now all of our currencies became pegged to the US dollar. So the value of those currencies were measured by the strength or weakness of the US dollar. This is why the US dollar has the biggest influence in the marketplace and not gold. Okay, now if the US dollar is bearish, it means every other currency pair paired with the US dollar is going to be bullish. Why? It means that there's a flight from the US dollar to higher yield assets. So investors are actually looking at foreign currencies as more profitable to invest your money into. Okay, so when the US dollar is bearish, all of our currencies, Australian dollar, New Zealand dollar, pound, euro, Swiss franc, they're all going to be bullish against US dollar. Okay, this is called a risk-on scenario because there's a risk in the US dollar. There's a risk in the marketplace, which is US dollar. Okay, the base currency of the world. Now, if there's a risk-on event, risk-off event, it means the dollar is bullish. Okay, the dollar is stable. The base currency of the world is stable, and every other foreign currency pairs of prices of commodities, which is gold and oil, you're all going to be bearish against the strength of the dollar. Okay, so now let's go to the charts. Let's see examples. Now, this is a DXY. The DXY stands for the dollar index. Okay, let's go to the daily time frame. Let's look at the daily time frame. So, remove all indicators, remove all drawing tools. Holy shit, remove indicator. Anyways, you put a vertical line around October 1st. All right, so now from October 1st until present, okay, from October 1st till present, the DXY was bearish. Okay, bearish DXY. So the direction of DXY was down. In our books, from our definition, this is called a risk-on event because dollar is bearish, meaning there's going to be a flight of investment, meaning a movement of investment away from the US dollar into foreign currencies or foreign commodities. Okay, the two commodities in forex market are US oil and gold. Now, from October 1st until present, the DXY was bearish. Now we're going to look at every currency pair paired against the DXY. So now let's start with all the commodities. Let's look at US oil from October 1st. Whilst the DXY was going down, okay, remove all drawing tools, October 1st. Whilst DXY traded down, at the same period, oil went up. Okay, so the direction goes up. I'm going to add this to watch list. At the same period, October 1st. Okay, let's go to October 1st. At the same period, October 1st, while DXY went up, okay, gold went down, then went up. Pin this to that. That's the watch list. Perfect. Pound, GBP, USD. The same period, whilst DXY was bearish, let's use a new one. Not USD. Let's see, wonder. Move drawing tools, go to October 1st. Perfect. GBP USD was what? Bullish. Was going up whilst DXY went down. Okay. If you look at AUD USD, the same thing. Whilst DXY went down the same time period. Okay. October 1st, the same time period, AUD USD went up. Okay, are you seeing how this is playing out on all of the currencies? All foreign currencies are being strengthened against the weakness of the base currency, which is the US dollar. So in the same time period, whilst the dollar was going down, New Zealand dollar was going up. So hopefully you guys can see all the correlation between all these currency pairs and the DXY. So whilst DXY is going down, all foreign currency pairs goes up because investments are being moved away from the dollar into foreign currencies. Okay, so there's a flight of investment from dollar into foreign currencies. This is why all foreign currencies go up. Okay, let's get back to the notes. Now, let's talk about the open, high, low, close. So what is your open, high, low, close? What makes up a candlestick bar? Okay, so now let's remove all those, blah, blah, blah. Let's zoom in. Let's look at a candlestick bar. Okay, let's put two lines on either side of this candlestick bar. Now, this is your standard candlestick bar. Okay, the open, where the market sat in new day, delineates a new day. The low, anything the market does below the open is called the low. Then the high, okay, what the market does above the open. Then the close, the price point at which the market closes. So we call this the, let's see, it's not already. High, low, close, open. With that. High, low, close, open. Okay, perfect. Now, if I go to a bar chart, okay, which shows everything, the high, the lows, the close, open, you're gonna see something like this, okay? Full candlestick bar, open, close. This is exactly what you're gonna see on that candlestick bar, okay? Let's switch. Exactly. Move, okay? Open, low, high, close. Now, what I'm about to teach you guys now is going to change your trading. Okay, it's going to change it for you if you're still new to ICT. Okay, so that tells you on a bullish day when the market opens, the market must first trade down. Okay, when the market opens on a bullish day from 10 GMT, when the market opens. If the market trades down, there is an 80% chance that it is going to be a bullish day, meaning you're going to get a bullish day. If you're going to get a bearish day, when the market opens, the market will rally up first. Okay, so now let me show you guys an example. Remove all drawing tools. By the way, the green candles are bullish days, the red candles are bearish days. So each candle bar represents a full day. Now, if you look at the red candle, this was open. So anything to the left of the line is the open. Anything to the right of the line is closed. Okay. So on the bearish day, the market opened, then went up first, then went down, created a low, and came back up to create a close. Bearish day, red candle, market open, traded up first, came down, low. Open, traded up first, came down, low. Now, bullish day, the market open, traded down first, traded up, closed. Open, traded down first, traded up, closed. Bearish day, the market opens, trades up first, trades down, closes. Opens, trades up first, trades down, closes. So now you're seeing a pattern in the marketplace. On bullish days, when the market opens, it is going to trade down first. On bearish days, when the market opens, it is going to trade up first. So now, how is this useful to you as a trader? Now, if you identify that your trend is bullish. Now, here, this is clearly a bullish trend. Okay, so we looked at DXY, DXY was bearish. If we expect bearish DXY, we want to see bullish NZD. Why? Because we are in a risk-on scenario. Okay, so now in a risk-on scenario, we want to see foreign currencies go up. If we want to see foreign currencies go up, not every single day is going to be bullish. You're going to be corrective days. You're going to be trending days. Okay, so now how do you differentiate between the days that you're going to get a correction and the days you're going to get a trending move? Look at the way the market opens first. If the market opens and trades up first, there's an higher probability you're going to get a corrective day. But if the market opens and trades down first, that is an higher chance you're going to get a trending move. Okay, so I just told you guys one piece of information that many people don't even know about. Many people, I don't know about this, but always forget to apply this. And now you're going to get a time when you can catch all those moves. I'm going to show you guys live on the chart right now. So we have about 22 more minutes to go. Okay, 22 more minutes. I'm going to show you something that you guys it's going to blow your mind. Okay, can you run that back one more time? Okay, perfect. Now, in risk-on markets meaning the US dollar index is bearish. We expect all foreign currencies paired against the US dollar index the US dollar to go bullish. Now you've gotten your trend that it is bullish. Okay, so now you have a bullish trend. In bullish trends, you want to buy, not sell. Okay, perfect. But now, in a bullish trend, the market is never just going to keep going up. Okay, you never see the market just go up in a straight line. Market always goes up, correct? Okay, goes up, correct. So the market is undulating, meaning it goes up, it makes waves, zigzags. Okay, now what makes you money if you want to be a buyer is when you're catching the moves that go up, not the ones that goes down. Now, the big question is, now you know in a trend, you're supposed to be a buyer in a bullish trend. How do you know if a day is going to be bullish versus a day that will be bearish? So what I'm doing now is I'm giving you the buyers every single day in the marketplace. Every single day, you know the direction of the market. Every day. Okay? So every single day you know the direction of the market and you can apply that. So if the market always starts 10 p.m. GMT. Okay, so now let me show you guys something. Let's go to a 15-minute time frame. 15-minute time frame. We bring out the session breaks. Okay, I think session breaks is activated. Let's see. Perfect. So now we have our session breaks on. Each of these red dotted line delineates each new day. Okay? Now I want you guys to watch something. Pay close attention. Right? Now, when the market opened here, mark this by X. What did the market do first? Went up. So from the open, the market went up. And now, what was the direction of the market for the entirety of that day? Down. Okay? Now watch. The market opened again 10 p.m. GMT. What was the first direction the market went to? Down. Market went down. For the rest of the day, what did the market do? Up. Okay? Market went up. Market opened somewhere around here. This was a long, huge week. Somewhere around there, the market opened. Where was the first direction the market went to? Down. Okay? Market went here down. For the rest of the day, the market went up. Okay? Now, today, when the market opened, on the 20th, when the market opened, the market went up first. For the rest of the day, the market went down. Okay? Market went down. When the market opened here, the market gapped down. For the rest of the day, the market went up. NZD USD. Today, current market price. When the market opened, the market went down first. Down. Then for the rest of the day, the market went up. So are you guys seeing what is happening in front of your screens? When the market opens, the first direction out of the market open is the false move. The reason why is because every single person wants to chase that direction. So when the market opened bearish, many people were trying to sell. Many people were trying to sell. Many people were trying to buy, thinking this was a continuation. Many people were trying to sell, okay? Many people were trying to sell. Many people were trying to buy, thinking this was a continuation. Maybe they drew their Fibonacci, they did something like, where's the Fib? No, Fibonacci. So maybe they probably did something like this. Okay, the market came down here, went up. So this is 786, the market is gonna keep going up. But they failed to see that when the market opened, the market went up first. So this is the way they get your money. This is the way they get you to take the wrong side of the market. Because you're showing you the false moves first. They want you to chase that false move. So when you chase that false move, they quickly reverse the market against you. Then you take your money. Then you say Forex is a scam. No, Forex is not a scam because what was being taught to you was the big scam. Okay, so now, once the market opens, the first move out of that market open is a false move. Now, I'm going to even refine it more. I'm going to refine the time when you should be trading, okay? So now I'm showing you how to get the market direction. Now, in an uptrend, you want to focus on being a buyer. You want to keep on buying. Don't focus on the sell side. Focus on the buy side. Not the sell side, the buy side. So what you're waiting for is for the market to open bearish first. That is your confirmation you want to buy. So I showed you guys NZD was bullish. Okay, yesterday you could have bought NZD USD because the market opened bearish first. You bought NZD USD and you're getting 36 pips. Okay, today you bought NZD USD, you're getting the entire daily range, 21 pips or 22 pips. Okay, that puts dollars in your pockets every single day. Every single day you're making money. Every single day. Okay, because you know the market direction. But on the 17th, it went down first. The week at a specific time, 17th went down first. Okay, no. Now, on the 17th, the market went up first, not down, up. Okay, let me read this. Market went up. This was where the market opened. Now, I'm not saying immediately the market opens, it has to go. I'm saying the first few hours of the day when the market opens, what direction did it go? The first 4 hours or the first 5 hours before London session. So this is where timing is very vital to you guys. Okay, so the first few hours of the day, the direction was up, obviously. The first few hours of this day, direction was down. First few hours of the day, direction was, You can either say up or down, but this was a whipsaw. Okay, so I'm going to show you guys how to get the market direction every single day using time zones. Okay, perfect. So going back, Terry, I had one more diagram to show you guys. Okay, so we have the standard daily candle bar for bearish days. Okay, if you want to see the market go bearish, you want to see the market open, trade up first, trade down, then close. Open, trade lower first, trade up, then close first. Standard daily candle bar for bullish days. Okay, now during bearish days, you're going to see more of opens, high, low, close. Okay, so now let me give you guys this trick. I want you guys to get this trick down. If you're bullish, you want to see open, low, high, close. In an uptrend, what you're looking for is open, low, high, close. Not open, high, low, close. Open, low, high, close. Mean open, down, up, close. Open, down, up, close. Open, down, up, close. Okay, uptrends, you want to see open, down, up, close. A downtrend, you want to see open, up, down, close. Open, up, down, close. Open, up, down, close. In downtrending market, okay? So now let's go back to NZD USD, right? We'll make this a daily chart. Daily. Remove all drawing tools. Uptrend. Okay, so this clearly is an uptrend. Go to the bars. Perfect. So now the market went on an uptrend from this point. So in uptrending markets, we want to see open, down, up, close. Okay. So let me lock on this. So open, down, up, close. Open, down, up, close. Okay. Let me get this. No, sorry, not mine. Open, down, up, close. Open, down, up, close. Open, up, down, close. We ignore that. Open, down, up, close. Okay. Open, up, down, close. We ignore that. Open, down, up, close. Open, down, up, close. 1, 2, 3. We ignore those 3 days. Open, down, up, close. Open, down, up, close. Open, down, up, close. So this is the way you get the bullish days. The bearish days, you ignore that. The market is on an uptrend. Okay, you are only focusing on all the bullish days. Okay, all the single open, down, ups, and close. Open, down, ups, and close. Open, down, ups, and close. Okay, so for a period of 83 days. Okay, for a period of 83 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 5, 6, 7, 8, 9, 10, 11. Okay, so for 31 days, you're buying. 31 candles, you're buying. And if you notice, the bullish candles have the largest number of moves. The bearish candles are usually smaller in size compared to the bullish candles. So that way you have just one direction. So this is how you're getting one direction for extended periods of time, and you're waking up each day doing only one thing. Once the market open, once it drop down, once the market drops down, you're buying using a 30 pip stop loss, and you're taking profit around 3-4 p.m. GMT time. Okay, I'm going to give you guys all the time zones. Okay, all the times when you should close your trades, all the times when you should be entering your trades, all that. You're doing the same thing every single day. It's enough for you to quit your job. It's enough for you to be stable trading Forex because you know the direction of the market every single day. You know what the market is going to do every single day. The market is bearish once the market open. First, go down first and close. Simple. Sorry, open, go down, go up, and close. Simple every single day. Okay, so let's go back to our market session. So now, in finding intraday entries, timing of entries is extremely vital. The London session is the most volatile session of the day, where 80% of daily setups occur. Most common, okay, this is most common on Euro, Pound, and Swiss franc pairs. So there's a 2 to 4 hour window for a setup to occur each session. This is where time and price theory factors. So now we go to market sessions. Why are there market sessions? When do the bank opens? What creates a market session? So I'm sure you guys do hear market sessions, okay? So what is actually creating the market session? Why is there the London session, the New York session, and then the Asia session? So now let me give you guys something. In the world, the three biggest markets are the North American market, the European market, and the Asian markets. Okay, write that down. In the financial market, the three biggest markets in the world are the Asian market, the North American market, and the European market. In Forex, we call the European market the London session. In Forex, we call the North American market the US session. So in North America, you have US, Canada, Mexico. In Europe, you have France, Germany, Spain, Portugal, Great Britain, Wales. Then in Asia, you have China, Tokyo, New Zealand, Aussie dollar, all that. No, sorry. Actually, New Zealand and Aussie are actually different. Those are the Wellington session, okay? That's entirely different. So just three major sessions: Asia, London, US. Okay, but around Asian session, the Wellington session, which consists of New Zealand dollar and Aussie dollar, is usually active. So Australia and New Zealand markets are usually active around the Tokyo market, which is the Asian market, because they have the same time zones. So now let me give you guys a reason why. What time does the bank around you open? In your own country or wherever you guys live, what time does the bank open and what time does the bank close? I want you guys to type that in the chat box. Quick. Okay? Trying to make a point to you guys. What time does the bank open? What time does the bank close? Let's see. I want you guys to answer so I can 8 a.m. to 4 p.m. 9 a.m. to 4 p.m. Okay? Everyone try to answer, what time does your bank open? 9 to 5, 8 a.m. to 4 p.m. Okay? 9 a.m. to 5 p.m. 8 a.m. to 4 p.m. 9 to 5. So we can all agree that all around the world, it's standard that the banks generally open between 8 a.m. to 9 a.m. and close 4 p.m. to 5 p.m. So that is a standard practice that banks all around the world opens 8 a.m. between 8 a.m. 9 a.m. their time zone and closes 4 p.m. 5 p.m. their time zone. Okay, so let me to you guys. Okay, now in London, European markets, because they have the same time zones generally, which is European time. Okay, the same time zone. So in Europe, when it is 8 a.m., all the banks in European markets are open. Okay? Hope you guys are taking notes. So in Europe, let's call it London, all the banks in the European markets are open. 8 a.m. to 4 p.m. Now, that's GMT. If you convert that, okay, to Eastern Standard Time, which is New York time, Eastern Standard Time, that gives you 3 a.m. to 9 p.m. Sorry, 3 a.m. to 9 a.m. 9 a.m. Yeah, 3 a.m. to 9 a.m. Okay, so you have a time frame of 3 a.m. to 9 a.m. USA is 24/7, but Federal Reserve opens at 12 a.m. EST. Okay, the banks are open 24/7. Okay, better. So now, but generally everyone agrees 8 a.m. to 4 p.m. This is where banks, physical locations. Now, I'm not saying services. Okay, bank services are usually 24/7. We're talking about the physical location. So the physical location, from my own understanding, is usually 8 a.m. to 4 p.m. or 9 a.m. depending on, but generally it's 9 a.m. to 4 p.m., 5 p.m. time zones. Okay, so now This constitutes to 3 a.m. EST. Okay, let's write 3 a.m. EST. Okay, to 9 a.m. EST. No, not actually 9 a.m. So you have 4 p.m. It's 5. That's 9. Oh, sorry. Minus 5. Yeah, that's 12, 11. 11 a.m. So 3 a.m. EST to 11 a.m. EST. Okay, perfect. Now, New York or North American markets are open. Okay, North American market, let's call that NYC. Opens, or let's call that US. Let's say US. So the US markets are open, okay, every single day. If we use the same 8 a.m. or 9 a.m., okay, EST, let's use 8 a.m. EST to 4 p.m. EST. Okay, so now if you're taking that to GMT, that gives you 8 plus 5, 11, 1 p.m. GMT. 1 p.m. GMT until 4 plus 5, 9 p.m. GMT. Okay, 9 p.m. GMT. Perfect. So, all right, so now the London markets are open 8 a.m., 4 p.m. GMT, which is 3 a.m. EST to 11 a.m. EST New York time. US markets are open 1 p.m. GMT, so 9 p.m. GMT, New York, that's London time, European time, whatever, okay? Now, the first 4 hours of each of this session is the most active session, okay? The first 4 hours, the first 2 hours to the first 4 hours of this session are the most active session because these are when the banks are opening. All right, these are when the banks, what bank opens 3 to 11? Oh, okay, conversion. All right, so these are when the banks are open. Now, if you look at any pound pair, a euro pair, during London session, oftentimes the moves are going to occur around 8 a.m. or 9 a.m. GMT. So now my own time zone is GMT plus 1. So that's going to be around 8, 9, 10 a.m. every single day. Okay, if you guys think I'm lying, let's look at an example, GBP USD. Let's look at when the majority of the move occurred on GBP USD. So now, this was an uptrend. So if we're going to be buyers every single day, if we are in an uptrend on pound US dollar, okay, we're going to look to buy GBP USD between 8 a.m. to 10 a.m. my own time zone. Okay, this is conversion rate. So 8 a.m. to 10 a.m. my time zone. All right, so now let's do this. The market went up today, open, low, high, close. So now between 8 a.m. and 10 a.m. This is 8:30 a.m. okay, or V. We bought the market between this time zone. Market went up 132 pips. Okay, what's going on? Okay, the low of the day came around 8 a.m. Okay, the high of the day came around 7:38 a.m. The high of the day came around 8:30 a.m. The low of the day came around 9 a.m. The low of the day came around 8:30 a.m. Okay, yeah, this one was actually due to news. So actually, this was a new day. So this, where was the high of the day before this market came up? So this high came around 3:45 a.m., 8:45 a.m. So around 8:45 a.m., the market was around that. Okay. Now, even on bearish days, okay, bearish markets, 8 a.m., high of the day. Bearish markets, okay, this was actually high of the day, 11:45 a.m. Okay. Bearish markets, 8 a.m. Bearish markets, 9:15 a.m. Okay. Bearish markets, 4:30 p.m. So this was actually different. This was US session. Okay, going back, bearish market 9:30 a.m. So now you guys are seeing the market doing the same thing every single time. So now the question you need to ask me is, why is the market, from what you've been showing me, so each of these vertical lines, only twice the market never made the low or high of the day between 8 a.m. to 9 a.m. So now the question you need to ask me is, why is it that 80% of the time, from what you just showed me now, why is the market giving us the low or high of the day? This is because the London banks are open around that time. So the first 2 hours of the day, this is when you're going to set the low or high of that session. Okay, London session sets the lows or highs of the days for each currency pair. Okay, for lots of currency pairs, London session sets the lows or highs for them for that day. Then US session is simply a continuation from the direction of London session. Okay, so oftentimes 80% of the time, London session is going to set the low or high of that day. And when is that going to happen? So now I'm giving you guys a 2-hour period where you can expect explosive moves. Now watch, after each of these vertical lines, the move out of that was explosive, always explosive moves. Why? Because the banks are being active that moment. They've set the low of the day. The only thing they can do from then on is to move up. Okay? Now watch. So now, when the market opened from this vertical line, dotted line, market went down first until London session. 8 a.m. went up. Market opened, went down first until London session. 8 a.m. went up. Market opened, okay? Now let me zoom in here so you guys can see clearly. Market opened, range, then it spiked up first. Okay, so the market went up first, 8 a.m. went down. Market went up first, 8 a.m. went down. Market went up, then went down. Okay, so I said the first few hours of the day, you want to see the general direction of the market. Okay, so the market went up, went down, then traded up. Okay, so the market was bearish until 8 a.m. 9 a.m. the market went up. Okay, market bearish up, bullish down. Okay, yeah, actually the market just went straight down. All right, so the market bullish down. So what we're actually doing is we're looking for what the market did just before London session started. The direction of the market just before London session started is the false move. That is your false move. So when London session opens, you want to be doing the opposite of that direction. Okay, no problem, deal. So let's see if we're almost done for today. So actually we've exceeded our time. All right, so I'm going to end on this note, okay? So oftentimes, or 80% of the time of the day, the direction of the market just before London open is the false move. London open, you're going to get the reversal, especially around pound pairs and euro pairs. Okay, so thank you guys for being a part of today's call. I hope to see you guys tomorrow. And before we go, I'm going to give you guys exercises. Okay, you guys need to do your homework. Right, so if you guys are not on the group, can we get the time zones? Okay, again. All right, perfect. So for London session, let me actually type that out on the. Now let's remove this. I want to give you guys the time zones GMT. So it's your job to convert that to whatever time zone you're in. Right? So I'm gonna type it out GMT time. So London, okay. Your kill zone, London kill zone for you, GMT time is 7 a.m. to 10 a.m. GMT. Okay, let me write GMT so you guys can screenshot that. Now, the reason why I kept 7 a.m., right, not 8 a.m. is because sometimes the moves could come in early. So 7 a.m. accounts for that. So between 7 a.m. to 10 a.m., that is where the 80% of the times the high or low of the day is going to form. Okay? Then New York, let's call it US, right? Okay. 1 p.m. to 3 p.m. GMT. So US usually is a continuation from London. So just before this time session, you're going to see the market make, if London was bullish, okay, just before this time zone, you're going to see the market start going bearish. Once it falls around 1 p.m. to 3 p.m. GMT, the market will create a low for US session and rally up again. All right. And now finally, Asia session or Asian markets open. Let's call this Tokyo because that's the largest market in Asia. So for this Tokyo session, Tokyo is 1 a.m. to 3 a.m. This is for yen pairs, Japanese yen pairs, especially for yen pairs. Right, so now you guys make sure you guys all write down these sessions because you're going to use this for the assignment. So basically 7 a.m. No, we are GMT plus 1. So if you're in Nigeria, you're in GMT plus 1. So that's 8 a.m. to 11. Okay, because you're GMT plus 1. Yeah, you expect, no, around that time zone, you want to see prior to that time zone, you want to see price do the opposite move. So if around 3, 4, 5, 6 a.m., the market was dropping, that tells you that from between 7 a.m. to 10 a.m., the market will create the low and rally for the day. Okay, perfect. So you guys make sure you all write down all these time zones. So that's going to be essential for your exercises. So your exercise now is on any pair that you like. Find out where the high and low formed, okay? And write down that time zone in GMT. That way you're going to know 80% of the time what to do every single day, okay? So hopefully this session was beneficial to you guys, and I'll catch you guys tomorrow, same time, 1 hour sessions, okay? You guys all have a nice night, a nice evening, and also happy holidays.